Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from Chartsandmarkets.com runs down the major markets. It seems everything was cooking until Friday hit. Ross tells us silver miners are shining bright this weekend. He also checks out gold, crude, and the U.S. dollar. Founder of the Schachter.Energy report, Josef Schachter, checks in from Calgary to drill deep into the energy sector and whether China has a heavy hand in running Canada's oil patch. He comments on tariffs, OPEC, the World Economic Forum, and electric vehicles. Ted Dixon, the co-founder of IncResearch.ca, Canada's first online financial news and research service, tells us about the economic advantages Canada has in minerals and energy. He believes Canada's copper sector may be the big winner following President Trump's tariffs on the metal. He also looks at what insiders are doing in the large, mid, and junior cap spaces. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from Chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Always a pleasure, Jim.
How are the stock markets doing this week?
Well, up until Thursday, it was up and away, and Friday we get a bit of a reversal here. The last correction we had was about a week ago, around the 20th to the 21st, in short-term oversold condition, and then bang, up to new highs. And that wasn't just in the S&P. It was in the Dow, it was in the Russell for the move. Now, the one that has been short in terms of its ability to move to new highs was the NASDAQ, which topped out in the middle of the month, and then this month, right at the end here on Thursday, it failed. I guess that's because NVIDIA has come off since its earnings, but the fact is that we're coming up on Labor Day, which historically, that first 10 days after Labor Day, you got to be very careful. If you start to take out support areas, once you get into September, they can feed on themselves right through until October. And, we know that October seasonally is the best time of the year to buy, depending upon the model that you're using. It can be up to the 30th of the month, or, in some cases, it might be out into the middle of November. But, we're at that point where some weakness would not be unexpected. And I think if we take out that support that we had on the 20th to the 21st, it'll have some downside momentum going for it.
What's going on with gold?
We are once again up here at resistance. We've got the spot gold price at $34.45. So this is the, fifth time now that we've tested this resistance. Originally, we got up here in April as the price got up to our long-term target that coming out of that 2015 low. And it's consolidated with just flat tops and rising support lines. And the most recent oversold there was about 3 weeks ago. And at this point, it's pretty important, I think, if it's going to try and break out right here, that for all that we're at 34.45, I think you'll look at somewhere around 33.80 as a pretty significant support. So if we can't manage to push through here, or we do and then we falter, it could have a bit of a correction. Now, within the precious metals, silver has just been outpacing gold since the first of the year, and especially since April when gold has gone into this consolidation. And so silver, we look at the weekly chart there, and been looking for a breakout in the relative strength index to trigger the move into the 5-year cycle high, which is on our work scheduled to happen in 2026. And this breakout that we had in the spring of this year really puts it in motion to make that run. The silver price is not only doing well, but the silver miners, if you look at SIL or the SILJ, the juniors, they are just outpacing everything here. And yes, some individual stocks might be doing better than the ETFs, but the ETFs are a nice way to play the move and not have to worry about company-specific exposure. Just enjoy the play as far as it's going. The golds, the GDX, the GDXJ also seem some really good solid action here. And, if anything, they might have had a little bit too much momentum this week, and maybe there's a bit of a setback to happen. But overall, the trend is in motion, and just enjoy it while it's there.
What's happening with crude?
Crude, it's having a bit of a reversal here off the lows, and nothing really, really big so far. But yeah, we were down at 62. Now we're up at 64. It's a decent bounce, but this is all within this trading range that we've been in for months now. And if anything, I would say if the rally fails to get through 66, the easiest move once again is probably back and retesting the support levels that we had in April, May. So that's around probably the $56 to $58 range. And if anything, I say there's no reason to be jumping into the sector. As far as the oil itself is concerned, the stocks, if you take a look at Exxon or Chevron and the Canadian names as well, having pretty decent runs here, but might be a little ahead of themselves.
What's going on with the U.S. and Canadian dollars?
The U.S. dollar is into a consolidation phase, and it really has started that since the early part of July. Had a really good bounce from 96 up to 100, and now just stuck around 98. And I would say that unless this can gain some upward momentum pretty soon, the easiest path is going to be once again on the downside. And I thought we had the potential to break out, but it just seems to have a lot of overhead resistance right now. And if we take a look at individual currencies, they look just the reciprocal of what you're seeing here in the U.S. dollar. Canadians had a pretty decent bounce, and if anything, it's doing relatively well. And in particular, when you look at the dollar relative to the commodity indices, it's a pretty good bounce.
Bitcoin, what's it doing?
Bitcoin is got a rolling top up here. It was had the all-time high at 124,000 occurred just a month ago, and we had a good oversold reading prior to that run up. Then it came back and tested the support around 112,000, and that was oversold again. But the rally out of that was mediocre, to say best, and now we're starting to erode to the downside. So this easy play on the upside has run its course from the April low, and I don't see any reason to be jumping aboard as far as Bitcoin is concerned right now.
Ross, thank you so much for being on This Week in Money.
Good to be with you, Jim.
My guest has been Ross Clark from Chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Josef Schachter, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Josef Schachter, founder of the Schachter.Energy Report online at Schachter.EnergyReport.ca. Josef, welcome back to This Week in Money, and how are things in Cowtown?
Well, it's lovely weather finally. We got 25 degrees, great time to be out biking, golfing, walking. It's a really nice time of the year, and we're busy working away here on different things, but I still get a chance to get out and enjoy the fresh air. And but winter's coming.
I was going to say Calgary. So when's the next snowstorm?
The next
or hailstorm. There's always something brewing coming over the Rockies.
Yeah, if you remember our conference in 2 years ago, 2023, it was 19 degrees on Friday, and then Saturday, the day of the conference, it snowed overnight, and traffic accidents everywhere. A lot of people couldn't come because they didn't want to drive in the snow and the deep snow, and so you never know. It can happen. It could be 19 degrees and then snow the next day.
Can you tell us about the Schachter.Energy Report for a bit and how people can subscribe to it?
Yeah, we created the Schachter.Energy Report in 2017, and the reason was there was not a lot of coverage on small, medium-sized energy E&P service companies, and there was a vacuum there, and some people that we knew at Money Talks, Michael Campbell, suggested that we create a product like that, and a subscriber product, a paid subscriber product, and we got it off the ground, April of 2017, and it just built and built. We cover now, we originally were planning to cover 20 companies. We now cover 37, and so we have a lot of different coverages from the biggest company being Tourmaline, 640,000 BOEs a day, all the way down to small E&P with great stories and great upside that are 2,000 BOEs a day. We also cover the service sector, pipeline infrastructure, and the royalty companies. So it's really been a great product. It's grown very nicely, and we match that with a conference once a year that we were talking about in October, where we have the companies coming, and we're looking at maybe 40-plus companies coming this year. Last year we had 702 people and 40 companies. This year we're looking for 800 and maybe more than 40 companies. And it's a good time for individual investors to have face time with the managements of the companies they own or are interested in. And there's really a lack of access to management for retail investors, individual investors. So our conference really is unique. And that we have it focused on the energy industry of today, energy industry of tomorrow. So we have renewable companies, lithium, copper, uranium names. So it's great attendance. People can just go to our catchtheenergyconference.com website, and they can find out more about it. We'd love to have them there, and you can get tickets that way. The other way, of course, is if you become a subscriber to the Schachter.Energy Report, you get 2 complimentary tickets as a subscriber. So that's another option for people to consider.
Your energy conference in Calgary is just around the corner on October 18th. Can you tell us about that and how people can attend it?
Yeah, it starts it's at Mount Royal University in Calgary. We start off in the Bella Hall, and usually we have somebody from the political energy side of it. 2 years ago, we had the Premier, Daniel Smith. Last year, we had Brian Jean, our energy minister. We're in contact with a very interesting individual, senior in the political area, that would be able to bring a nice perspective on energy. Until we have the firm commitment, I can't talk more about it. But then we have the day where first thing, I then do a macro piece of, what I see going on in the sector. Then I talk about all the companies there and how people can spend their day. A lot of people we find own 3 to 5 energy companies. So we have 5 sessions during the day, so you can go and see most of the companies that you own if they're there. And then you can go learn about companies that you don't know. So Again, you can go to the Catch the Energy conference website but just to buy tickets, or the more efficient way is become a subscriber, and we provide you with independent research on the companies. And what we have is something called balance of evidence. So what we really like in what they're doing, and if there's issues that we don't like, insider selling, too much debt, not doing return to shareholders. So we make it very clear. We provide information that the majority of brokerage firms can't do, simply because they can't have the negatives to the degree that we can talk about. And we're pretty clear that, when we don't like something, we say it pretty clearly. And if we really think it's bad, then we say sell and we terminate coverage. So that's something that you don't normally see in the investment research sphere in Canada.
President Trump wants lower interest rates. Do you think he also wants lower energy prices to make the economy boom?
Yes, he does. And it's pretty clear he wants the low energy prices. I think that's why, Venezuela, which was supposed to have some tough sanctions, they've allowed Chevron now to bring oil in as long as it doesn't go to the Maduro empire to be ripped off and go into their pockets. Low interest rates, of course, he wants. He's been taking a 2x4 to Chairman Powell. He wants 50 basis points decline, or more, he talks even 200 basis points decline in rates. The problem is we just had a good GDP number, up 3.3%. In a week from now, we're going to get the jobs report for the month of August. If that number is positive and more than the average of the year to date, that's going to make the Fed halt what they're doing. And inflation data is getting worse. For a long time, people thought that the tariff would hit the numbers, but it took a long time because you have to get through the inventory that was already in country, also the inventory that was bought before tariffs were implemented. So it's now only starting to show up. And if inflation is bad, and we're already seeing the PCE numbers get higher, the PPI numbers getting higher. If the Fed sees those, then the market's looking at it this way. They expect, and they've already discounted the market a 25 basis point decline. If it was a 50 basis point decline, then people would start worrying that maybe the Fed sees something on the economy that says recession. If they do nothing, then people will say, oops, the Fed sees too strong inflation, and they're not worried about employment. If the jobs data is okay, that would be something the market would not like to see. And again, all of that comes out to us next Friday. So it's going to be, there's a lot of economic data coming before the next FOMC meeting, and we'll all be watching it to go through the detail and see, what the positives and negatives. And if the economy is slowing and jobs are not there, then the Fed will cut. If, on the other hand, we see too strong an economy and inflation pressure, my guess is, and I'm in the camp, that there's no change in September unless we see a big change in the job number. So next Friday we'll find out, and if, depending upon that number, you can then have a higher prospect understanding of which way it's going to go.
President Trump is cleaning up crime-riddled Washington, D.C. It looks like Chicago and other cities are next. Could that cause an economic boom in the U.S.?
Well, if people feel safe and they can go out, and you've seen the mayor of D.C. saying they appreciate what's going on. The city they've interviewed people on the streets that say they couldn't go out for dinner. They were worried about being robbed and carjacked. And I don't know if it was 2,000 people have been arrested and hundreds of guns taken off the streets. The problem is D.C., Washington is controlled by the federal government, so they can do it. In places like Chicago and L.A. and other places, you really need to see something big break out violently. And of course, if you live in the Golden Mile part of Chicago along the waterfront, where the high-end housing is, and where all the wealthy and the more of the white population lives, it's not a bad place. But if you live in South Chicago, where all the violence is and where people are being killed, and there's been more than one death a day, since the beginning of the year from the data, you sure aren't happy with seeing your young people being killed by gang fighting and shootings. But the the crime statistics can also be manipulated. If they don't want to show that crime is bad, they just ignore the data. So I'm skeptical about Chicago and LA and some of the other cities that are having big violence, and I think it's not being taken care of, and so the people there, I think, have to start pushing the politicians to do something, and if they don't, then maybe the feds do need to go in. Will it be an economic boom to the states? I don't think so. It will, in the sense that restaurants in Washington D.C. are open now, and nightlife is there because people feel safe on the streets. So you could argue there'd be an economic positive. I wouldn't call it an economic boom, because if you look at parts of Chicago that are doing well, like around the waterfront areas and the downtown, but if you go to South Chicago, there's nothing going. The economy is sluggish because of all the problems.
Well, in South Chicago, the 3 or 4 hospitals there won't accept gunshot wounds because they're worried people won't have insurance.
Oh,
so,
yeah.
So they have to travel to the north side of the city.
Yeah, there's so many people in the United States that can't afford insurance, even though you have the Obama plan in place and Medicaid and Medicare. But if you can't afford the premiums that still are part of the package, it makes it very difficult. So people have to decide between food and housing and medical care, and sometimes medical care is the one that gets dropped, and the cost of medicines in the States are much higher than Canada, and so people just at some point don't take it, and that of course impacts their longevity and weight, and you see a lot of pictures when you show pictures of the streets in many cities in the States, and you see a population where people are overweight.
Do you think tariffs are a key tool to stop wars and strengthen the U.S. economy?
Well, the U.S. has such a big budget deficit, and after World War II, the Monroe, you had the help that they did to Europe to recover, to Japan to recover. And so you had all of those support did it, and they were willing to have deficits, trade deficits, because that was helping those countries recover, and so that was a positive. But this thing is now 70 years past that, in terms of time, and now many of those countries are wealthy. They have good industry, they have lots of jobs, high tech. And the Americans are still having a big deficit, trade deficit, so they want to narrow that. So, and part of it is low wages. Vietnam's wages are different from America's. China wages are lower than America's. So, if they can use that advantage to underprice and, the Walmart effect, send cheap goods to the United States. So, I think the tariff is forcing more equitable trade between countries. It brings more money in to cover parts of the deficit. It was $30 billion, and I think in July, the tariff revenue, people are talking about $400 or $500 billion, but that's nothing compared to the $2 trillion deficit. So it's not going to solve the financial problems of the states. Debt's going to go up $37 trillion, heading to $40. They're talking this year the annualized budget deficit could be $2.5 trillion. And next year they're saying it could be bad too, because of the tax cuts, the extension of the big beautiful bill cutting taxes. U.S. deficits are going to still be big, and while tariffs help lower it, the U.S. wants lower interest rates so they don't pay so much in interest costs. But at the same time, if the economy is humming along and growing nicely, the Fed, if it's independent and can stay independent, even though Trump wants to change that, lowering interest rate materially doesn't make any sense if the inflation rate is higher than the interest rates. You've got to have higher interest rates, not lower.
Are there bullish and bearish cases for crude oil?
Yeah, let's start with the bullish case. Right now, demand is about 105 million barrels a year, up from 103.8 last year, so up 1.2 million barrels. Next year, we could be 106 to 106.5, so again, up over a million barrels plus. And so that increase in demand, when you look at supply, there's no real growth around the OECD. The U.S. numbers are flat. The OPEC countries, maybe Saudi Arabia and UAE, can raise a little bit. You might see more out of Guyana, but not enough to meet the demand growth. So the bullish case is, number one, economic recovery and strength in 2026, and not enough money being spent to replace decline rates. That's bullish. And then the most bullish part of it could be if there's any, geopolitical challenge where any of the waterways, Straits of Hormuz and Suez Canal or Straits of Malacca, if there's any disruption in the system for travel of ships with bringing oil, that could boost something. If there was a war or some disruption in any single country, remember Libya's had on and off fights and between the two opposing groups there and shutting the oil fields down. So you never know where it could come. It could come in, it could happen in Iraq. Of course, Iran, is being, pressured on sanctions. So you could have all of those things be the bullish case. On the bearish case is if there is, not so strong economy, then we could see somewhat lower prices, and I'll go through price ranges soon. And then the other one would be is if Russia and Ukraine come to a peace agreement and Russia has sanctions removed, then they could increase production 1 million, 2 million barrels from the 9.6 or so that they're at now. They're the second largest producer in the world. The Americans are the first with 13.4. Then there's Russia. Then you go to Saudi Arabia. Saudi Arabia can increase production a bit. So you could argue that there could be more production coming on, which would satiate the increase in demand, and then you could see lower prices. The big thing for the industry, it needs 65, 70 to break even. To make decent money and to justify increased spending, you need $80 WTI. We're 64 or so today. On the bearish side, we got down to 54, 55 in April. Anything below 60, the industry shuts down. The rig count gets soft, as we'll talk about later in one of your, in one of the other issues to talk about. And I think that we have, because we're heading into the shoulder season, the summer driving season ends after the September long weekend. Usually inventories build, and when you have inventories building and demand is down by 1.5 million from the summer, strong summer driving season, those inventory builds can cause the price of oil to come down. And if Russia is moving to negotiate, then the sanctions, American sanctions, won't be on Russia, and secondary sanctions on India and China, etc. Then I think we'll see a break of 60. But I think it'll be like April. It'll be another fabulous buying opportunity, and that's what we're telling our subscribers. We're looking for one more dip, break 60, 57 to 59. We'll get a trigger, probably of buy signals. We'll send that out to our subscribers and say, time to add to positions. We've been telling people, hold your cash, hold your dividends, wait for the next low-risk buying opportunity. The last time we table-pounded buy was April, May, and I think we might see that in October of this year. And then, we talk about all the names we cover, and so people can decide based on their risk profile, dividend requirements, market cap size. They can do their homework, figure out which names they want to own, and be ready to buy them when we get the next buy signal, and then we'll send out an action alert to our subscribers.
Is the Ukraine-Russia conflict causing volatility in the price of crude?
Oh, yeah. If you remember, before Russia invaded, the price of oil was in the 70s. And then when they invaded and the people were worried about it went to 120, and then it backed off, as you know, into the mid-50s. So volatility is high. If you remember a week ago, people were talking about secondary sanctions on Russia. Price of oil bounced up to $3. And then when Trump started talking about allowing American companies to go back and work in Russia, like ExxonMobil and Sakhalin Island with Rosneft, and he was using that as a carrot, to induce Russia to come to the table and negotiate, not only a ceasefire but a peace agreement that everyone can live with. Nobody's going to get what they all want, and not all the land is going to be returned to Ukraine. And then we're going to have a tough time getting this to the finish line. But if they have trilateral negotiations, I think that would kind of cool markets down. And if that happens during the soft period in the fall, we could see that 57, 59, and that would be a buy signal going forward. And then there's a lot of cheap stocks out there right now, and especially natural gas focused. But I think if we see oil stocks back off a little bit, then you'll have some great buys right across the board.
How are seasonalities looking for crude oil and natural gas?
Yeah, let's separate that. Crude oil usually weakens in the spring when inventories build, and in the fall even more so when inventories build. And then they bottom right before winter, and then they take off again. Natural gas is the same thing. When the inventories are building, the winter demand is November 1st to March 31st. So that's when you have big draws when there's cold weather. That's when you get the highest prices for natural gas. And then during the period of the injection season from April to November 1st, that's when you can see prices be sloppy. We were in the 3-4s, just in the last month or so. Now we're backing off because inventories are building. And again, November 1st is still a bit away. So we're seeing sloppy prices both in Canada and the States. Canada worse so because we had, construction and infrastructure, was going through maintenance cycles. And the same thing with pipeline, checking. So we had, very soft natural gas prices, and about a BCF of gas couldn't find a market. So it went for minuscule amounts. I think I saw the price today for AECO 75 cents. Nobody makes money at 75 cents. But if you have a condensate well and you have a byproduct of natural gas, you really don't care what you're selling it at. And that's the problem that hurts the dry gas guys, and prices of natural gas are sloppy. But once we get LNG Canada moving from 300, 400 million a day to the BCF that they're targeting by year end, that's going to help. And then, of course, winter, you never know. It could be a mild winter. It could be a cold winter. Some people are saying we're going to have another one of those La Nina, or, the one that's the colder one, El Nino or whatever. I'm not sure which is which anymore. And that could impact demand for natural gas. So I'm optimistic that we're going to see, $4 plus NYMEX, $4 or $5 NYMEX during the winter, during the winter months. And in Canada, we'll probably be in the threes, which would be a decent economic price, because a lot of companies break even at $1.50. So if you're getting $3, that's good. And if you have export contracts into the Chicago market or into Dawn in, Sarnia area, or you have, Tourmaline and ARC that have contracts into both, into the Gulf Coast to the LNG markets, that's going to help. So I think there's going to be a bullish case, winter 25, 26, that's going to give us a lot of upside, both in the commodity price and in the stock prices. So this buy opportunity that I see happening in October could be one of the best buying opportunities we've seen in a long, long time.
Does OPEC still control some of the crude oil markets?
Yeah, OPEC produced. If I just go to the numbers here in June, I think I've got the July number too. 27. Let me get that number. Yeah, 27.5 million, and the demand right now is about 105 million. So you take that 105, that means about 26% is from OPEC. And it's the swing producer right now. It's no longer, the numbers are not big enough for them to really make a difference. So, but when we get to tighter markets, as we did in 2008, in Q1, Q2, the price of crude went from $80 to $147 because things were tight and OPEC was running full out. So if we did get to something like that again, that'll make a big difference. And, the number for July was 27.54 million barrels from OPEC. The biggest producer was Saudi Arabia, 9.5, and it was up by 263,000 barrels. But if you remember, they made an announcement saying they're going to grow production by 411,000. Well, it was really they were going to grow their quotas, but many countries that got more quota just didn't have the ability to increase production because they haven't spent money on it. All the money coming in is used, for the government, and so you see, no growth at all in there. And until they start spending serious money drilling, for example, Iraq had a decline of 51,000 in July. You had a 12,000 decline in Iran. The only places that had good numbers were the Saudi Arabia up 170,000 and UAE up 109,000, but the overall number was 263. So that makes a big difference in the numbers. And I think that OPEC will get its power back once everything is running flat out, which could be 2027. And then, depending upon if they want market share, do they want to charge? What do they think is a fair price? Is it 90, 100? But if the prices get up to 120, 130, it's going to force a lot of inflation pressure. But more importantly, it's going to have demand destruction because people will not drive as much if the price of, if you've got to go and fill up your car and and pay $3-4 a liter, you're definitely not going to drive as much.
What's the latest rig data?
Well, the latest rig data from last Friday shows that the overall U.S. rig count was at 539 rigs, down from 586, down 8%. Of that, interestingly, the gas ones were up 122 versus 98, up 24.4%, and that's because of the data centers in places like Pennsylvania, where more natural gas is needed for data centers and power. That's helping there. Plus, of course, LNG numbers are bigger in the Gulf Coast. Oil numbers, though, were 412, down from 483 a year ago, down 14.7%. So nobody, at $64 oil, the companies don't see the incentive to drill as much, and they're only drilling their tier one best wells. And even then, they're slowing down that drilling and they've announced it because they don't like the price and they can't make a lot of money. And shareholders are saying, we want shareholder returns, we want debt low, and we don't want you to grow if the numbers don't make sense. For the Canadian side, we're down to 183 rigs from 217 a year ago, down 15.7. Gas rig count, 57, down from 66, so down 13.6. But again, because of the cheap price of oil, we're at 126 oil rigs, down from 151, or down by 16.6%. So that's really an issue here, is that the rig count's coming down and is low. And again, markets are irrational. If you don't get a decent return on your investment, why spend it?
With stock markets hitting new highs, is there a bullish case and a bearish case for stock markets this fall?
Well, let's go through the bullish case. Is that the tech sector is generating, fabulous earnings, cash flow, growth, revenue side, everything is there. But valuations are ridiculously stretched, even more than the dot-com peak. And so the positive earnings continuing help. But if you saw the data from NVIDIA, it's showing that the revenue growth is decelerating. It's still up, but it's decelerating, and it'll decelerate even more in upcoming quarters. The other thing was that they announced in their 10Q, which is the legal document for the SEC, that one customer was 23% of that $40 billion of revenues. So, $10 billion or something like that. It was, of the, 40 plus billion of revenues was one customer. Well, you satiate that one customer, what happens in future quarters? So, you don't want to have many customers over 10% of your number if you're in a business like that. I think the market got spooked by that. And, so that's a concern. the bearish case is the valuation, the fact that consumers are not spending. We're seeing a lot of data from companies in the consumer-related area that their numbers are bad. We saw today Nike say they were going to get rid of 1% of their workforce. So you're seeing companies retrenching, and we're seeing bankruptcies. Restaurant chains are talking pretty, the things are bad. People want value, so even McDonald's has got special deals now because people don't want to pay for the higher cost of, if you want to get a Big Mac and fries and a drink, it's probably double what it was, pre-COVID. So the numbers just don't make sense. But we know beef prices are up, and we know wage rates are up, minimum wage rates are up. So the bottom line is, if you look at the balance of evidence, my view is the near term is negative. We're in a frothy market here. I think people, and I've been saying this to our subscribers, take some profits, build up some cash reserves for another low-risk entry point. And the worst valuations are in the tech sector. So if there's going to be a crack in the market, it'll be there. And stocks there could go down 20, 30, 40%, just like we saw in past corrections when the tech sector gets ahead of itself.
Are consumers still consuming?
Yes, they are, but they're value oriented. They're watching their spend. I was in Walmart just a few days ago to pick something up in one of the departments, and I was walking through the store, and you could see people buying, back to school stuff. And when I was talking to one of the salespeople, they were saying they're buying, but they're not buying as much, and they're looking at the cheaper alternatives. And if you go, if you talk about the restaurants again, people are buying the low-cost items at McDonald's, or, Papa John's is even doing, deals on pizzas, and Domino's and all the others are. And, the leaflets you get in the mail now from everybody from KFC to Harvey's, they're all trying to get you to come with special deals to come and buy their product, which tells you that things are not so good. And that they need to incentivize you to come back. So I think that, with the pressure we have from housing costs, insurance is higher, education costs are going up, families are, cost of cars, you have to replace your car. You're shocked by the sticker price today versus when you bought your past one, if it's 5 years old. The sticker shock is unbelievable. So I think that we are looking at middle and lower income are probably being very careful with their spend and probably spending less. The affluent that have big investment portfolios, big real estate portfolios, they don't care. They're just going and spending whatever they want. Taylor Swift is going to have a wedding that'll probably blow the budget of the next 10 biggest ones ever. And, the other thing is Disney. I was reading an article about Disney that, the people who are wealthy get ahead of the line. They get, better. There's different restaurants. They don't have to, have the long lineups to get in. The price point, they're willing to pay as much higher. So Disneyland, which, for all of us when we were kids, was a great place to go and not a costly item for the families, now has become obscenely expensive. And for people going on the regular, price point, it's high. But to get the special deals, the price point is excessively high. And only the top, 10% wealthy in America can do it. But there's enough of them that Disney can afford to have a two-tier system, which is, you almost feel that's annoying and disgusting, because Disney's supposed to be, Walt Disney was more of a egalitarian on this stuff, and the people running Disney today are saying, "Hey, there's rich people out there. Let's tab them."
What's happening with real estate?
It matters where you are. In Alberta, it's pretty strong because the migration into the province is pretty high. We have more housing being built. I think the report from the Herald showed that we have more housing built year to date in Calgary than there was in Toronto. So the big difference in the populations between the two, and yet we're building more because they're willing to allow more more townhouses. They're allowing more land to be developed. and the inner city is getting developed to a greater degree, in terms of height restrictions, which you have in Ontario, Toronto, but you don't have them here. And again, there's articles out there all the time saying that Vancouver, Toronto, and LA are the most, or San Francisco and LA are some of the most expensive housing in North America, and places like New York are cheaper. But I think even Montreal is more expensive than Calgary, and I think that if you're in an area like as you are in New Westminster, or here I'm in Calgary, the prices are more reasonable. But if you want to be in downtown Vancouver or downtown Toronto, you better have you better win the lottery or have made a score in something so that you can afford to live there, or have parents and family that are willing to help you.
President Trump wants the government to get partial ownership of companies that the government finances. Is that a good plan?
Yeah, there's two schools of thought here. The conservative view saying government should have ownership of companies. But if you remember, during 2008, 2009, to save the auto industry, the government gave them loans, the banks got loans. Almost everybody that needed financing got help from the Treasury and the Fed. And so why not, if you're giving money to a company to save it, that you don't get something back for the taxpayer? So you may get the loan get repaid in 08, 09, and sometimes you had equity there too, which made some profit to the government for taking the risk. I don't see, for companies like Intel, which are in bad shape, that need the government money and need the government support, that 10% of the company going to the government, to the taxpayers, not to Trump's personally, but to the taxpayers, if it works, and at some point they could sell it. I think that's a positive. There's been a lot of talk about the defense industry, but the defense industry doesn't need, they need the contracts, but they've got to bid on those contracts. So there's a couple competitors bidding for drones, for submarines, for frigates and destroyers, you name it. So there is a competitive landscape there, and the companies are healthy. It's not like they need money for day-to-day operations. Where the government has a case, though, is the U.S. shipbuilding industry is not really there to the degree it was, decades ago. So right now, a lot of stuff gets built in South Korea or Japan. And so the United States may want to rebuild that shipping industry, so they will need to rebuild the ports, rebuild the shipyards. There you might build a case saying, okay, if we're going to give you this money to rebuild the defensive capabilities of the United States, we should get an equity interest for doing that. That, to me, makes sense.
Do you think the U.S. and Russia will become strong trading partners?
What's interesting is right now everybody talks about Trump's, screaming at Putin and against Russia sanctions, secondary sanctions. But right now the United States still buys certain types of uranium, can't remember the hydro something, and they're buying fertilizer, they're buying cobalt. So even though your adversaries, you're doing it, even Europe is buying energy products that are, the energy goes to India and China. They process it into product, and then Europe buys it. So there's always ways around it. Could the U.S. and Russia become stronger? Well, the United States and Russia are number one, U.S. were number one, Russia number two in energy. So there's no deal there. But ExxonMobil would like to go in. They were involved in Sakhalin Island, and when after the invasion they were out. They could go back in and be involved in developing it with the latest technologies, which Russia doesn't have. But the U.S. could be back there. Remember, McDonald's was there and they sold out. They could go back in, and you could see a number of industries. Russia has a lot of natural resources, and they probably need capital to develop them, especially rare earths, so that there's more of those available, because magnets and all the things that are needed, tungsten, etc. So I think that there is a chance for trading partnerships after we see something happen on peace in between, in Ukraine. But I don't think you can say the word strong trading partners. I would just say trading partners, just like I would say it would be with the U.S. and the EU, or the U.S. and, Vietnam, Japan, others. It would be a reasonable number, but it wouldn't be the best and the strongest.
In Canada, companies receive subsidies from the Carney government to hire migrants over Canadians. What's the likely outcome of this for the Canadian economy and society?
The question is, the jobs are out there, and do Canadians want to take those jobs? So, if it's a low entry level, if it's a service area, so maybe the migrants are willing to take those jobs at lower rates than, Canadians who've been here for generations that would want to. We need to have that opening for people to come in and take those, the service in the healthcare area, restaurants. That you got to have those door opening jobs that are not high paid. While the Canadians who've gotten themselves an education, blue collar trade, an electrician or a plumber, they're going to make way more money than they would, working behind the McDonald's counter. So you could argue that the government allowing, I don't know if they receive subsidies, but they, that part of it I don't know the details on. But the low entry jobs are really those service entry jobs. What about that as an outcome for the society? We need that mobility up the chain, and as these people, migrants come in, take those low-end jobs. If their kids get educated or they get educated, they can move up in the mobility side. So I think that kind of mobility and integration, where they learn the language and become fluent in English, or in Quebec, English and French. I think all of that mobility is important for our society. I don't know anything about subsidies, though. That's an issue I'll leave for someone else.
In the U.S., ICE is cracking down on illegal migrants with raids on farms that has driven workers away before the U.S. open border policy who worked on the farms.
Well, there was a system of work permits that the U.S. had, where people from Mexico, Central America could come in for the harvest season, 3-4 months a year, get good wages compared to what they would get back home. They would come in, they would be housed at the farms, they do the work, do the harvesting, go back home. And so they made good money doing that. And then, I don't know if the number of visas was not enough, or the paperwork got to be annoying. So they started hiring illegal migrants, and then of course we saw the ICE raids. And of course now farms are saying that they can't bring in the harvest, and so they're tilling them back into the ground, and that's why you're seeing. I saw an issue, and I wrote about it in our Eye on Energy that came out yesterday. Eggplant, which used to be $1, is now $1.50. So because they can't harvest everything, and they don't have enough workers for the farms, we're going to see it with fruit and vegetables. As months to we're already seeing it, but it'll get worse. Tomato prices, everything, lettuce. So I think that the ICE raids are stupid. You see the same thing with the casino raids in Vegas. In Vegas, the Vegas casino owners are saying, stop it. We need these people to do these jobs. And we don't have others from the American society who want to do them because they're low-paying entry jobs. So I think that, we may have to just make sure that there's no criminal records. Maybe they have to get some kind of permitting process. But I think that for the mobility and for, in the system and for getting those jobs done, low entry, low pay jobs, we do need to have a little more, openness to allowing that to happen so that the American economy can function.
Evidently, President Trump wants to designate the World Economic Forum a terrorist organization. A number of politicians and corporate leaders in Canada are members of the World Economic Forum. Could this hold hope for a return to sanity in Canada?
Look, the World Economic Forum wants a centralized world government where they control it with their socialist left-wing agenda, climate issues that they want resolved in their favor. Nobody voted for these schmucks. There's my view. And my view is that the World Economic Forum's days are over. You've got so many countries, leaders in Europe that are annoyed with them and the push that came from them. North America, especially the U.S. is rejecting them. So I think the leader who created the World Economic Forum is also out, and there was charges of corruption, which they reviewed. I think that those like Carney and Trudeau who went there, who are part of it, you still see a big amount of companies and politicians and others going there. But I think its power is not as much as it was. To call them a terrorist organization, I think is beyond what Trump can get away with. But he calls people a lot of names. So, but I don't think it's going to matter. The power of the WEF is gone, and especially in the United States. So we'll see what happens. But I think that its influence on political decisions and on policies is going downhill.
Could the European Union's days be numbered, and what could that mean for energy?
Well, the big problem with Europe is that the EU leadership has never been elected. The people in the countries there don't elect them. They elect members to parliament, and the leaders there are elect themselves. So it's not direct voting in Germany, Poland, France for these people. So that's number one. Number two, they haven't the debt loads in some countries and are very big, others not so. You've got big deficits in France, and Germany is now thinking of deficit spending because of the defense needs. You've got Greece, you've got Italy, you've got all kinds of financial difficulties around the place. And so with the decision that they want to increase defense spending to 2.5%, 3%, and then moving to 5%, I don't think these countries can afford it, and they have massive debt. They can't. They have massive deficits. They can't raise taxes, and not have the population rebel. So you could argue that the EU may find itself in difficulty in the years ahead, depending upon if they do get into a war situation with Russia. I think in some cases we've seen people like Martin Armstrong say that the likelihood is of something happening between them because the war drums are there, their spending increase the military are there. You don't build a bigger army and more equipment if you're not going to use it. So I'd be concerned about the EU and of course NATO.
How long do you think Prime Minister Carney can ignore how big a problem fentanyl is in Canada? And what do you think President Trump's next steps might be to force Canada to shut down the significant fentanyl industry in Canada?
Yeah, I don't know enough about it, but what I would say is that Carney knows that this is a big battle with him, over getting a trade deal. If the government of Canada is not willing to, go against, the imports, from that are coming through the ports in Montreal and Vancouver and other places, and do something, then Trump's not going to do a trade deal, and Canada will suffer. So at some point, he's going to have to make a decision that he has to, spend more time on this and, watch the border to make sure that there's not a lot of fentanyl crossing. We're not a big problem compared to Mexico, so it's but it is a problem, and the Americans have a reason to be upset. And again, this is part of the arm twist that's going to happen for the trade deal, and Carney has to take that into consideration if he wants to placate Trump and get him off the back of Canada on this issue.
We keep hearing rumors that the Communist Party of China is in charge of Canada. Do you think they're involved in Canada's energy sector?
Well, there are, CNOC and Sinopec are involved in the oil and gas industry in Western Canada. They have operations. They have production. They're involved in the LNG by both buying. They're buying oil, from the TMX pipeline on the coast there. So I don't know. I would say in charge, no. Influential, yes. They have a large number of students coming to our universities, and they pay more than local residents do. So there's an economic benefit to our university system. Canada is looking to do more in the States. More with China. But as you know from what's going on with canola, every once in a while China takes the hammer out, and you thought you were making progress, and all of a sudden you lost a few steps and lost some billions of dollars of exports.
Looks like Robert F. Kennedy Jr. is starting to tear apart Big Pharma. Are we likely to see this happen in Canada too?
Well, Canada's already got lower prices for pharmaceuticals than they do in the United States. And so Trump is trying to get them, to raise prices elsewhere to pay for the R&D. Right now, the Americans are paying for the R&D to develop these products. And so they're trying to say that it should be shared globally, because globally they are benefiting from the new generations and newer solutions to health problems. So I think it's an argument that you can say is legitimate. And I would say that we in Canada have been benefiting from lower prices, and we may be paying more, but again, generics are going to be a bigger part of it and hopefully as things get off their patents, then we'll get more generics, and that'll maybe balance things out for us.
The Canadian dollar's been in a trading range for a few months, though it looks like it wants to go higher. What do you see ahead for the Canuck buck?
If I'm right that the price of oil breaks 60, we're going to break 70 on the Canadian dollar, maybe 68, 69 cents, but not lower than that. If I'm right that next year we see 75 and then 2027, 80 or $90 WTI, then we'll probably reach 80 cents onto the upside. So it all matters where the price of oil is. It's our biggest export, so it really generates a lot of foreign, U.S. dollars for the Canadian industry. So if you're selling it at 64, right now the Canadian dollar conversion might be 139. If I'm right that we go to, $80 or $85 U.S. For WTI, Canadian dollar might be 80 cents. So the question is, what's the revenue stream? But it's still going to be a big one into Canada. So right now I'm in the cautious camp, looking for a cheaper dollar. But heading into the end of this year and going into the outlying years, 27, 28, I expect a strengthening dollar year over year. And I don't see us getting back to parity or premium like we were, a couple decades ago. But could we be an 80, 85 cent dollar 2-3 years from now on a consistent basis? That is possible in an $80, $90 WTI environment.
The U.S. dollar's also been trading sideways for a few months. Do you think President Trump would prefer a weaker U.S. dollar?
Well, it would help with exports and, balance the trade numbers. So there's a benefit for a U.S. weaker dollar. But on the other side of things, if the dollar's weaker, why would foreigners want to come in and buy U.S. bonds? So, if you come in and buy a 10-year treasury and, the 4% yield, 4.2 or whatever, and all of a sudden you lose 5-10% in the currency, why would you do it? So they need a stable dollar so that investors will come in and help buy the foreign, the U.S. debt to finance the deficit. And also you want them coming into the U.S. to, build manufacturing. Well, you don't want them to lose money on the currency either. So a stable dollar versus a dollar that swings 5-10% a year, that volatility is too much, and that's going to affect investment in the States, be it for the bond market, for U.S. Treasuries, or for building capital investments in the U.S. You don't want to put something into the States expecting a 10-12% rate of return, and then all of a sudden the price of the currency goes down 10%. Whoopee! You got the shaft.
Are electric vehicles becoming more popular in Alberta, where you have very harsh winters?
In the big cities like Edmonton and Calgary, where there's charging stations in the cities, yes. You don't see it in rural Alberta. And the problem is, of course, the winter. The charge doesn't last as long. And so even if you're living in Edmonton and Calgary, you may need a charging station at home or be close to a charging station. So EVs, I think, kind of peaked in Alberta. and I don't see it picking up until the batteries can last longer. From my perspective, even when the weather is nice and warm, for me to be able to drive from Calgary to Edmonton is not possible with many of the cars. You got to stop in Red Deer with not so many charging stations, and in the winter you probably can't even get from South Calgary to North Calgary. So I think the winters are the big problem for EVs in Canada as a whole, and that's why EVs in Canada have not taken hold to the degree that they have, in Texas or California or warmer climates elsewhere, where in Europe where there's lots of charging stations and you've got longer periods of time during the year that the EV is functional appropriately.
What kind of vehicle do you drive?
Gasoline, both of them. Yeah, it's just like for me to go from Calgary, I can fill up my tank, go up to Edmonton, fill up there, come back home, and I'm not even using a half a tank of gas, each direction. So to me, that's the way you want to go. If an EV could go one way up to Edmonton with lots of room, and in the wintertime, then you could bring that to the table. But the technology is not there at this point. So gasoline is what I'll stay with. I love some of the look of some of those, South Korean vehicles, the Ioniq and some of the others that are out there. Again, winter decisions, tell you you'll need two cars, one a highway car and one a city car.
Where can our listeners subscribe to the Schachter.Energy Report and find out more about your upcoming energy conference?
Well, for the Schachter.Energy Report, www.Schachter, Schachter, energyreport.com. For the conference, you can go to www.catchtheenergyconference.com, and you can buy tickets directly through the Catch the Energy website to come to Calgary for the conference on the 18th of October, or become subscribers. If you own energy stocks, we provide a coverage of a lot of companies. You can go to our website, www.Schachter.energyreport.com. You can see, we have older versions of our research that people can see what we do, and they can see the large areas that we cover of a mix of companies, see some of the reports, and see the balance of evidence that we talked about earlier. And, if it's companies that they own, having our product is very useful. Just one good idea out of our product in a year more than pays for it. So, for people who are in the energy sector, it's a must read, and we're seeing that from our subscriber responses from new people, becoming subscribers and enjoying the product. And tonight we're doing our quarterly webinar. That's another thing we do, is we have a quarterly webinar where I talk about the markets in the first half, then we have a Q&A on that, and then we go into the company areas. What are the best picks to look for when we get the next bottom in late October? Then we go into questions on companies from the subscribers, and then we have people can put through the chat line questions that they want to ask as well, both on the overview and company specific, and we get a very, very good response, in terms of our clients wanting to be involved in it, and so it's a very, very good product, and people hopefully will become subscribers and join future webinars which are quarterly. And then again, as I mentioned, you get 2 complimentary tickets to the conference, and we usually get 30 to 40% of the attendees being our subscribers. And again, because we have subscribers from all around the world, the big draw is from Alberta, probably 40-50%, and then we get a good draw from the Lower Mainland. People from Toronto, we get people coming in from Europe. Family offices come because we cover companies that aren't covered by the mainstream investment media because of the size. So if you're interested in small, medium, good growth, upside companies, being face-to-face with them is a big added value. So, for those listening, if you own the names, just check our lists of companies we cover, you can decide to come to the conference and have a chance to talk to the company's management that you own or companies that you're interested in. That face time is very, very valuable for you to feel comfortable owning the names you own or to become invested in a new name.
Joseph, thank you so much for being on This Week in Money.
Oh, my pleasure as always, Jim. It's a pleasure.
My guest has been Josef Schachter, founder of the Schachter.Energy Report. He was speaking to us from Calgary. Our interview took place on August 28th. Coming up, Ted Dixon next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Ted Dixon, CEO and co-founder of IncResearch.ca, Canada's first online financial news and research service, providing insider news and knowledge to investors. His website, CanadianInsider.com, home of the Canadian Insider Club. He's speaking to us from Vancouver. Welcome back to This Week in Money.
Jim, thanks for having me back, and it's great to be with the How Street community on This Week in Money.
In the U.S., the real economy looking to expand physical plant versus the Wall Street economy betting on an AI super cycle. What's the story there?
We picked up something noticeable in our insider filings in the U.S. midsummer. We saw bankers buying regional and small banking stocks pretty strongly in midsummer. Meanwhile, brokers and service providers to Wall Street, they were selling quite significantly. Now, we picked this up in our August 6th U.S. market report that was published on Inc. Research and also InsiderTracking.com, which is a kind of our U.S. focused website. And we wonder, well, what's going on here? And in fact, most of the U.S. market, we're getting downbeat overvaluation signals from insiders. Now, insiders, they're not the silver bullet. They're often early, but they've been making a lot of money by selling their stocks here as the U.S. market gets up to all-time highs. But the one standout where insiders have been buying quite a bit is in the banks. And we looked at it and we thought, well, one reason might be is because the banks have been underperforming at that as of midsummer. Now they've caught up. A lot of the banks, the KBE, which is a bank ETF, it has actually caught up pretty much neck and neck with the S&P 500 now as we close August. But there might be something else going on. And what we thought might explain part of this was the fact that Trump is really trying to refocus the U.S. economy into producing things, making more stuff that physical stuff, right? Like processing the materials that go into smartphones, making cars, right? Things like that require materials, but also, putting things together with your hands. This all requires capital investment. And we're getting the sense from banking insiders that, look, heck, maybe a lot of small, medium-sized firms in the U.S. are going to have to go to their local bank and get a loan to actually expand their plant and deal with this new, call it the new economy, but the tariff economy in the U.S., where a lot of supply chains are going to have to reconfigure to deal with these tariffs. And, if Trump's strategy in the U.S. pays off, or doesn't pay off, but works out to what he's looking to do, we would see more money going into physical plant and physical equipment and expanding production lines. But that money's got to come from somewhere. So for a while, yes, you can dip into your savings. Companies can dip into their savings, but we suspect that there's going to be a good old-fashioned credit creation in the United States to help with this build-out, and that will put Main Street in competition with Wall Street for that capital. So we've had a decade plus of money printing going to Wall Street, QEs here, QEs there, zero interest rates. Oh, we're going to cut rates again. But this time, the cutting rates will likely be of benefit to the U.S. government that has a huge deficit problem. So, as we know, the Trump administration has not been shy in demanding that the Fed cut rates to help fund the deficit. So a lot of the rate cutting is going to help the federal government, but we could also see it helping regional and Main Street banks. They get a normal yield curve where they can borrow money at low interest rates on the short end and lend them out a bit longer at the long end. Then that's sort of the classic bankers market. So maybe we're seeing a transition in the U.S. to a more kind of real-world economy. But that has big implications, if we're right, about what's in store as we head down the home stretch here in the year. Because as everyone knows, the AI trade has been front and center. But look, that's a Wall Street trade, right? There's nobody that benefits more from this AI trade, except for if you have some stock options in an AI company that goes public, sure. But Wall Street banks, they do the financings. They would get the commissions on these public offerings. They certainly get commissions for those companies that are trading that have big AI exposure. It's a big Wall Street play, and if that starts to run into a headwind in competition from Main Street, that could really put a damper on the overall U.S. market in terms of the S&P 500, which is a market cap weighted index, in terms of that index being able to power ahead here. Well, under the hood, you could still have opportunities as the economy shifts, where you have real companies that do make real things as opposed to software start to attract capital and attention. Now, the other big headwind facing AI plays is the elephant in the room has showed up to the AI circus, and that is China. And now China is competing in the AI space. And Jim, if you're running a business, you don't want to compete with China. You just don't. And I still think that North American investors have yet to get their heads around the implications of having Chinese competition, not only in these chatbots like ChatGPT now versus DeepSeek, but also you're going to have chip competition, the semiconductors. As we all know, semiconductors have been a big driver, through NVIDIA, have been helping to drive these returns in the U.S. Well, NVIDIA may have some competition now from China. We'll see. I'm not a microchip expert by any stretch of the imagination, but I do know that the valuations in these stocks are very rich, and they're priced pretty much for glory days ahead. Well, going to battle with the Chinese in any market is not glorious. It's tough, and I'm not sure that, I doubt that any of these publicly traded AI-related stocks in the U.S. have valuations that reflect the tough competitive environment that's likely ahead. So we'll see. Our insiders' signals are suggesting real economy versus the Wall Street economy for the U.S. As we head into the home stretch here in 2025.
Ted, before we went on air, you mentioned that Canada has the ME advantage. That's standing for minerals and energy. Can you maybe start off with minerals. How do we have a big advantage?
Right. So the Canadian me advantage. We see a lot of headlines in Canada about challenges we're facing on the tariff front with the Americans and Donald Trump, but I think a lot of that has been overblown by the politicians. Many politicians have benefited from really hyping that issue. Now, that's not to say there aren't issues. There are, and it's a big problem for our auto industry, for our steel industry, for our loom industry, and our lumber industry. So those are major sectoral issues. I would hope our policymakers would focus on how to make those industries stronger in light of these developments. Now, in terms of where Canada sits for opportunity in this, new Trump tariff world, we see that we have the me advantage, and that's minerals and energy. Now, so for minerals, this has been a really fascinating summer. We went into the summer waiting to hear what Donald Trump had in store for copper. They were doing a national security review, which basically allowed them to bring in special tariffs for the copper industry to protect it because of national security. But they had to do a study first. They can't just, unlike sort of Trump's presidential economic emergency tariffs, if you're going to do a national security or a national security type tariff, you have to do a study and do your due diligence and present that. They came to the conclusion in midsummer that yes, they were going to put tariffs on copper, but the big surprise was that the tariffs were going to be on the products to help the refiners. The tariffs weren't going to be on the raw material. So we had a big sell-off in U.S. copper futures because they were priced for tariffs, but there weren't going to be any tariffs. So as we were waiting for this decision by Trump on these tariffs, we thought that this is going to be great for U.S. copper miners because they would, get these tariff protections. But as it turned out, it's actually better for Canadian copper miners because as part of Trump's national security strategy. Now, this could change because, as we know, Donald Trump does change his mind from time to time, and it may even have changed in the last 48 hours or so since I've checked it, because, again, you just keeping up with the comings and goings of the White House and their policies are almost impossible to do. But as far as I understand it, U.S. copper miners may have to reserve some of their production for domestic refiners. Well, if you're a copper miner, that's not great news because that means you may not be able to get the world price for your copper because you have to sell some of it domestically. But Canadian miners do not have that issue. They can sell to the U.S. if they want, or they can sell to China, or they can sell to Germany. So Canadian copper miners actually have come out of this stronger. And I'm not sure that the market has fully understood that. This happened during the summer. Not everyone's paying attention. And, there are miners that I've seen in Canada that I don't think, are still sitting there from the copper sell-off. But I don't think investors have fully got their head around that, Canadian miners now should be actually trading at a premium, possibly, to American miners as a group. Every single miner will have a different situation in terms of its competitiveness and efficiency. So it's not a rule that you can apply to any specific name off the cuff. But in general, this has turned out to be good news for Canadian miners. So you just don't know sometimes how the ball's going to bounce in Trump world. The other good news, though, that we did get from Trump for Canadian mining this summer was on the graphite side, and they're going to put tariffs on imports, I believe, from China on the graphite side. but not, Canadian miners will not have that problem. So both U.S. and Canadian graphite producers, as it stands right now, this can all change, of course, as it stands, I believe right now. Maybe it has changed. Again, it's really hard to keep up all the time with what's going on. But as of sort of midsummer, Canadian graphite producers, were benefiting from that. So Canada went into this trade war with mineral extraction as a comparative advantage globally. That has even become stronger, which to me suggests that there has never been a better time to be investing in Canadian listed mining stocks than now, particularly those that have operations here. And, once you get out of Canada, you do have to look case by case, like where the mine is, how's its trading relationship with the U.S. So, we had this shake-up in the copper mining. Well, now, this could happen in some other field, who knows when. But as things stand right now, I've never seen a better time, given that where prices are, where the commodities are, whether, given the pivot that we talked about in terms of going into the Trump administration pushing for an expansion of the real economy in the U.S., all requires minerals, metals, to build out the physical plant. So it's a really good time. And for Canadians who are, been set back by the tariff bloom in the country and the general economic malaise that we've had in Canada. And I'm not, I won't go down that road too far, but we just had growth numbers come out this week that are negative. The Canadian economy is not doing so well, but there are pockets that are going to do quite well in this new environment, unless policymakers come in and mess it up. Now, I think we have an understanding from all parties from the last election that you don't want to mess with mining, that mining is a winning area in Canada, and I don't see any major party willing to upset that apple cart or thinking that it's in their interest to go and shut down mines and make it harder to do mining. I don't see that. And same at the provincial level, the province by province, it is different. But I think in British Columbia, we're still pretty good here, based off the track record, based off the fact that, we are getting, mining production here, getting new mines approved. So it's looking good in BC. Alberta, Saskatchewan are all pretty good. Manitoba, as a general rule, I haven't seen too many mines there being built, but I also haven't seen too many regulatory problems in that province. And there's a number of projects on the go that we followed. We've just written about one this month that is looking, at gold in that province. And there's other projects that are on the go there. So Western Canada is looking pretty good. Quebec, Ontario, those need to be looked at on a one by one situation. I think, you obviously have to look at every project in terms of its individual aspects, but in terms of the regulatory environment, I think you have to, Ontario, for example, really depends on where in the province you are. That can make a big difference. So, and in Quebec, of course, you just don't want to be around any of those areas where the moose, migrate. Stay away from those areas, and you'd probably be okay. But it's it's a really big advantage in Canada in the mining area. And the Canadian Insider Index, we just finished August here. It was up today about, I think, 28 basis points. So the U.S. market was down. It's going to finish the first 8 months of the year here up about 16, just over 16.25%, whereas the S&P 500 looks like it's going to be up just under 10%. So we've had big outperformance of Canadian Insider Index, insider stocks here in Canada. We've outperformed so far the TSX Composite as well, just by about 80 basis points as it stands right now. And when we went into the year, it was a different story. Some of our stocks in the index got hit with the tariff volatility, but thanks to a real strong showing by the miners and the gold miners, I was looking at what the big gainers have been year to date in the index, and you've got 1, 2, 3, 4. So the top 5 year-to-date performers in the index are all in the materials sector. The top 4 are gold and copper miners, and you've got actually a newcomer into the index that does rare earth processing. So basic materials, but mining, it's been a great story so far, and we just wrote in our August Top Mining and Crypto report why we think this story, the Canadian mining mineral story, is just getting warmed up. We've got some really big tailwinds for the mining group. Basically, we've talked about some of the Trump tariff factors that are working for it, but there are some other big factors as well, and that includes we've got this fiscal dominance in the U.S. We've been writing about really since 2023 in our Top Mining and Crypto report, but that's basically where the central bank has to pay more attention to helping fund the fiscal deficit than they do having to fight inflation. And we see this now visibly with the Trump administration trying to take over the Fed. So when Biden was president, you had to kind of convince people that this was at play, and they go, what are you talking about? Oh, the central bank is independent, and you say, well, look what they're doing with how there's, restructuring the portfolio and the debt, and how the Fed is, still keeping interest rates fairly low. But it was a harder sell, that theory, until really the last few weeks, where it's become fairly obvious that Washington is looking to the Fed to help it fund the deficit by lowering short-term rates. Well, that's really good news for the precious metals complex. And besides the situation with fiscal dominance, you've also got the ongoing situation with geopolitics. And that situation looks like it's still in motion for some time. We have got a major meeting of the UN General Assembly coming up in September. And normally investors can ignore that, but there are a couple of big issues that are going to be on the floor of the either the Security Council or the big General Assembly. The Security Council is a smaller group, as most of your listeners will know, and the General Assembly, which doesn't usually get a lot of attention because it doesn't have the same oomph in terms of resolutions as the Security Council. It's going to be, apparently, now things can change, looking at the question of recognizing, giving Palestinian statehood. Now, that will be controversial. We don't know where it will lead. It probably will not be something that will impact markets, but you never know until you go through it. But the bigger issue is the snapback sanctions that it's at play on Iran in the Security Council. That was triggered in the last week of August by Germany, France, and the UK. Basically, what it means is that they're calling out Iran, saying they haven't lived up to their agreements under what's called the JCPOA, which is the nuclear agreement they had struck, I believe it was in 2015, with the U.S., European nations, I believe China and Russia, and maybe some other signatories. But what it basically did, if Iran fulfilled certain obligations, then sanctions that were on Iran would be lifted, and they were lifted. But now these three European countries, UK, France and Germany, they're saying, oh, no, we don't believe Iran has lived up to its end of the bargain. We want these sanctions to come back. And so now that they've triggered this, there's basically 10 days from the date they triggered it, which is, I believe, August 28th, for them to kind of figure out a way to kick the can down the road a bit more. And if they, by doing an extension of the sanctions relief for Iran, if they don't do that, we have a showdown between Iran, Russia, and China, and U.S., the UK, Germany, and France. So this could impact markets depending on how it plays out. So that is probably the more important issue. But the fact of the matter, you've got these two big issues coming to the United Nations in New York starting next week. It's going to be, I think, something to watch, and it's just another sign that the geopolitical tensions in this in this world are rising, and Canada is one of the markets where you can hedge yourself and hedge your portfolio through exposure to precious metals miners. And also, I guess it's the E is the energy. And that's another reason why Canada's looking pretty good, because for those investors who take these geopolitical risks seriously, and I know there's a lot that don't, because they think that nothing ever happens, although there was this 12-day war we saw in June, and there seems to be a complacency in the market that is over. It is not over. There is a cessation of hostilities, but there's no treaty, there's no agreement, unless there's some really secret agreement that was made between Israel, Iran, and the United States. This could which I'm clearly not aware of, and I haven't seen any commentators talk about it. It's always possible, but I think the base case is that this is an unresolved issue, and that it could flare up at any time. We've got potential catalysts at the United Nations in September. We will have to see how things play out. But let's just say everything's status quo remains, and we don't have any confrontation. Let's hope we don't. Well, then, you've got the normal supply and demand situation with crude oil, for example, that investors will have to contend with. But if it does flare up, then you'd want to have some exposure to oil and oil producers. So that, just on the hedging side, again, it provides Canada with an advantage, because we have great oil and gas companies and uranium companies listed in Canada. And in terms of, let's say, everything gets smoothed out, let's just hope, we do get some breakthroughs in diplomacy and the United Nations, everybody kind of figures something out. Great. That's great. So let's talk about the supply and demand. Well, what we've also been pointing to in our reports is the risk of peak tight oil production in the United States. And what we do know, and what we wrote about in our Energy Top 30 report in August, is that, well, let's just say the jury is still out on whether we've had peak shale oil production in the U.S. What is clear is that the growth rate in U.S. crude oil production is falling. So, for example, in 2023, as of May, for the 12-month period ending May, in 2023, crude oil production grew 8.4%. In 2025, it grew 2.2%. So it's getting harder and harder to get another barrel out of the ground in the United States, and the United States was the big swing producer in terms of providing extra barrels to keep the price of oil down coming out of COVID. If the U.S. is now kind of plateauing, or even if their growth is slowing, that's going to be a net positive for the oil and gas group, assuming that global demand holds up, and there's various forecasts on that. If you pick a ballpark, 1 million barrels a day, growth a year, then, those barrels will have to come from somewhere. And if the U.S. is not as able to provide those barrels, then the countries that are reputable and reliable producers, like Canada, can fill the void, that should help on balance valuations of Canadian oil and gas companies over time. So even if you're not concerned about the geopolitical situation, if you're an optimist and you think that everything is going to smooth out, and let's hope it does, then we're back to the supply and demand fundamentals, and there's risk that the U.S. will not be able to produce the barrels that Donald Trump advertises that they can, and that is a risk that you can hedge with exposure to Canadian oil and gas stocks.
Globally, are dividends back in the spotlight?
Well, I think if the Fed cuts rates, which is expected in September, that should help make dividend payers more attractive, because the rate you get on government bonds and short-term government bonds will be less, and there are a lot of dividend payers, in Canada, especially if you're willing to go into the resource end, that have really good competitive yields with government short-term government securities. And if you're in a more volatile period, like we talked about on geopolitics, and even without the geopolitics, if you get into this real economy versus Wall Street economy in the United States, that's going to bring in more risk and volatility, I expect, in the markets. We saw the VIX, which is the volatility measure, short-term volatility measure in U.S. big cap stocks. It cut down under 15% annualized volatility this week. And every time it's not a sure sort of sell signal for the market when it gets down there, but because usually volatility and stock prices go in opposite directions. So if volatility starts to rise, stock prices are going down. It doesn't always work that way. But when you get volatility at very depressed levels, it usually means stock prices have been going up, and perhaps you're with too much exuberance, and that there's a correction coming ahead. We saw volatility get really depressed again, sort of late summer here, and for all the factors we talked about, I just talked about earlier, there's a pretty decent chance that I think volatility could move higher, at least in September, and that again should help support dividend payers, because you're getting some cash up front. You don't have to wait years and years for the growth story to come through as you would for non-dividend payers. So globally, I think you're looking at dividend stocks could have a decent run here into year end and into the new year. So that would be a bit of a change in the first half of the year, and during the summer, everybody was still very, very excited about AI and the AI prospects. But you never say never. I mean, I think that the AI story is starting to hit reality. That you've got more competition, and the pathway to profitability for some of these big AI plays, or profitability, or grow, or making money off of these AI investments that they're making, in some cases billions of dollars, that's becoming less clear. If you don't have the same visibility, you can't justify the same valuations. And yes, in the U.S., you do have this passive flow of money that doesn't seem to care about the valuations, but on margin, if you get active investors taking less of an interest in AI stocks and more of an interest in real economy stocks, eventually that will have an impact on valuations and the size of these large U.S. tech firms. They'll start to get relatively smaller in the index as more active money moves out of them, which means even the passive investor will be buying less and less of these stocks as we head in towards Christmas. If this scenario that I painted plays out, but we will have to see.
Does this big rush to AI remind you of the 2000.com bust?
Oh, for sure, it does. And, history doesn't exactly repeat, but it does rhyme. And there's similar characteristics of extending projections in terms of capital spend and user adoption and profitability assumptions. Very similar, I would say. Yes.
What are insiders doing in the large, mid, and junior cap spaces?
That's a really good question. And we have found, and we've been doing this now for over 2 decades, that insider activity is much more meaningful in the small and mid-cap stocks. So it doesn't mean what's happening in the larger cap stocks isn't meaningful. It is, but the signals usually take longer to play out, and sometimes you have structural issues that come into play. So we would put more attention on generally what insiders are doing in the small and mid-sized companies from, an opportunistic, if you have a shorter term, if you have a time horizon that's between, now, let's say 18 months to 2 years, then I think you want to look at what the smaller and mid-sized companies are doing. And in Canada, it's still pretty good. We continue to see bullish sentiment in the small junior market in Canada. But this has been the case for some time, and I think, there's been some structural challenges in the junior market from that now, unfortunately, going on for a decade, and part of that challenge has been money going into technology stocks in the U.S., but I think that's slowly unwinding for some of the reasons we discussed earlier. But in terms of what insiders are doing, in venture and junior stocks, we still see 3 stocks with the insider buying for every one was selling. That is absolutely phenomenal. Whereas on the TSX, we're down now we're seeing a slight advantage into the sellers. We're seeing basically we've got just under 1 stock with key insider buying for every 1 stock with key insider selling. So we're starting to see a bit more profit taking. Again, we're seeing the Canadian Insider Index at all-time highs, so it's not surprising to see some profit taking in some of these larger names, like the Canadian Insider Index. It's 50 names preferred by insiders, but they all have market cap minimums and liquidity requirements. So it's an institutional index. So you're going to have more medium-sized companies, maybe some smaller cap companies. Beauty's often in the eye of the beholder in terms of small, medium, and large. But let's just say that's more of a mid-cap oriented index. You're starting to see some selling there, but that is normal bullish behavior. It's not until we would have to see a lot more selling. Now, we may be having to downgrade the Canadian market, the TSX market, to fair valued soon. Right now we have it undervalued, but if this level of selling keeps up here, we may see a downgrade. Now, what that means is from here, you may want to brace yourself for kind of average returns in the broad Canadian market as opposed to above average returns. So it's still not bearish, but it's just not. It just suggests that a lot of the bargains have been gone. There'll still be individual opportunities at the stock level, and right now we're still seeing enough insider buying though that keeps us upbeat on the prospects for the Canadian market. But a lot of the easier plays have been done. Some of the easier pickings earlier this year have been done, so it's just going to get a little tougher to identify those opportunities. And that's why we follow the insiders closely. That's why we do our morning report every day, every trading day, to pick out situations where we see insiders still buying, even in a bull market, or sometimes we come across ones that are selling that we think people should know about. And but right now, we still see the buyers in control.
Ted, thank you so much for being on This Week in Money.
It's my pleasure, Jim, and all the best to all your listeners as we head into the fall.
My guest has been Ted Dixon, CEO and co-founder of IncResearch.ca, Canada's first online financial news and research service. You can find him on X at IncResearch. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Josef Schachter, and Ted Dixon. And thank you for listening. If you have any questions for the show or for any of our guests, you can send them to info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.